Hi, I'm Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to look at OPEC Plus and really go through, what's happening on a geopolitical level within the organization, and what can we expect when we're looking at going forward in terms of new supply coming online. Then we're going to round out and look at, what's happening in the emerging market land, what's happening with China, and give a brief update in terms of the geopolitics, but also the demand origination that we expect coming from the Asian nation. So here, let's just really kind of dive into the Libya and Turkey agreement. So why does Libya, why do people talk about Libya and Turkey and Egypt, and what is actually happening within Libya? So there was a hope of an increase in exports as there was a lift of the embargo, and now the embargo is back in place. So just to give a breakdown, the GNA, which is the Government of National Accord, is backed by NATO and Turkey. And then the LNA, which is the Libyan National Army, is backed by Russia, UAE, Egypt, and France, depending on who you ask at what time. And the LNA is led by General Haftar, who is a U.S. citizen, just to give you an idea of how convoluted some of this is. Now, the bigger issue is the GNA and Turkey entered into an agreement to essentially have this new zone of common interest to not only explore for oil and gas, but also to have a certain amount of new designation of territory. And as you can see by the picture, it cuts right through Greece. So obviously Greece isn't happy. And a lot of these other countries, specifically Israel and some of the other nations are within NATO, because, this also takes away routes for the pipelines. So now you had a pipeline that was supposed to go from Cyprus to Greece. You were going to have pipelines coming down from Greece to kind of meet midway. And this technically takes it all away. So why would you do this? And this is one of the reasons why you're starting to look, because you can also see it bleeds into Egypt's territory. Now, the Mediterranean is expected to have a significant amount of not only gas, but also oil. So Egypt is looking at this and saying, you're taking away some of our land as well. And why would you do that? What is the initiative here? And this is where Turkey and Russia start to get involved, because Russia and Egypt also know that there's a lot of opportunity, and they're looking to make deals with the LNA to do their own exploration. So again, everybody has their economic means of being here. But how do you really kind of push that through, and how does this get resolved? And the short answer is it really doesn't in the near term. And so these are just the specific areas of control. So the GNA and allies, which go back to the NATO and Turkey, Sirte is the linchpin, because that's where it's a huge strategic location for not only pipelines but also roads going west to east, north to south. And you can see the GNA doesn't really have a footing in a lot of these locations, which if you look at where the oil assets are located, a lot of them are in the south as well as in the eastern side of the country. And now you can see why Egypt cares so much, because Egypt wanted to help target ISIS, and Haftar was the best at doing that, which is why Egypt and the LNA are so unique in terms of their connections. So Egypt, the UAE, and Russia have been very adamant and have been very aggressive in providing not only intelligence, but also equipment to help deter the GNA and Turkey from kind of positioning themselves and really advancing. So this is the stalemate we're currently working with. And the reason why this matters is because it took about 1 million barrels a day off the market. So the question is, how quickly can we get back on the market? And that's why we keep seeing, Russia's sending mercenaries into refinery locations and oil storage ports, and there's just a lot of unknown. And the problem is both sides know they need oil to really get the populace to give the populace the money they need to buy the control that they really desire from the tribal entities, because most of Libya is really driven by tribes. And these are individuals that have essentially signed on to say, look, we need to get this oil back into the market because we need revenue. And this is where who controls the revenue? Who controls the purse strings? And that's obviously where it comes down to, how do we get this back into the market? And this will remain a big problem as we're going forward. But again, we're right at the stalemate, and the stalemate is going to be CERTI. That's going to be the one to look at, because that is where the next flashpoint is going to be in terms of the GNA and allies and the LNA and their allies kind of meeting headlong into some potential conflict. But again, this is why it's a very convoluted issue, but does have the potential to put about 1 million barrels a day back on the market. Not all at once. 350 to 360,000 could come back relatively quickly. To get back to where we were, you'd have to do a lot of testing. There was some damage to not only infrastructure but fields, so you have to go through a lot of this process to get to that point. But what about the crude that is available? And here you can see crude loading schedules, some of the early indications. And we just look at Angola, Nigeria, and Russia, because Russia, you can see the increase. This increase is going to get back closer to about 3.5 million, just based on early estimates for where, things are kind of the trajectory for what they're indicating as we go into August, because July, they're starting to kind of bring things back. But August is really where you're going to see that bigger increase. And in Angola is the one where we've seen another 200,000 barrels get added in September. So August they should be compliant, but then September is where we see that big surge of new oil coming into the market. The problem is there demand for it? And that's where we turn to floating storage. So here you can see the West Africa floating storage hit a new all-time high for 2020, which is a bigger problem, because we've been talking about how we're starting to see discounts come through for Basra Light coming out of Iraq and specific West African grades. And this is why they're saying, okay, well, we'll give it a little bit of time, see if there's an adjustment in terms of demand. The problem is Angola is not seeing the demand, Congo, and now Nigeria, which is putting more and more cargoes into storage. The Chinese problem in terms of just the amount that's sitting offshore means that this West African floating is only going to increase over the coming weeks unless we start to see some normalization, specifically in Asia, as some of these cargoes get pushed back. And now this is just one side of the OPEC story, because now we have to look at Middle East. What's happening in Middle East crude floating storage? And here we can see that we've kind of normalized and we've kind of plateaued here. The reason why this chart looks a little different is because we want to show where 2016 was and kind of where we are. So we're now above average, but the idea was that as we have, because now the new estimates is for July, we're up about 600,000 barrels coming out of the GCC, which you could say is coming out of OPEC, but the GCC, which is the Gulf Cooperation Council, is starting to bring some stuff back online. Now, some of that will be consumed locally, but others will also get pushed into the market depending on what their consumption is for power. And this is why the plateau here could be a problem, because this could show that there's also falling demand for Middle East crude, which is going to leave stuff in storage here. So this is going to be one to watch. And the problem is we're starting to see softness in pricing. Urals are trading at a discount, at a discount we haven't seen in 3 months. Iraq's Basra Light is trading at a discount. So these discounts means that you're starting to have to incentivize people to take your oil, which again is implicitly saying that demand is starting to weaken. And here is where we turn to Asian floating storage. So we've started to come off a little bit, but again, we haven't really come down all that much because this is all of Asia. So we've seen India increase a little bit. We've seen South Korea. We've seen Japan, which has pulled some of this oil off the market, which is good to see in terms of some of that normalization, but China remains flooded. And China's been the big buyer, which has kind of driven this number to these all-time highs. So without China really kicking back over, we're not going to see a meaningful move down. Now, the other thing that's going to have to be considered is really what's happening with Iran, Israel, and Iraq. So Iran or really their backing of Hezbollah is becoming a much bigger issue as we turn to the Golan Heights, as we turn to Lebanon, and how Israel is really kind of carrying out these different strikes. Now, the U.S. clearly supporting Israel in their means of going after Hezbollah, a recognized terrorist organization. It's also reacting with rocket attacks within Iraq against not only Iraqi military equipment, but also U.S. equipment. So these are things where they are rocket attacks, which just means means it's not so much an intelligent missile, but a rocket, but it doesn't mean it can't cause a lot of damage if it hits the right target. So these are things where we're starting to see some of the uprisings. Again, it's not a huge amount in terms of impacting crude and in terms of what can actually flow. But again, as things start to heat up, we're going to continue to look at that and say, okay, well, this is now going to impact exports. And then to round it out, Oman just went into a national lockdown, which is going to put more crude on the water because they're just not going to consume as much. I believe the curfew is going to be in place for 18 hours out of the day, which again, it just continues to show that there is just a significant amount of problems as we start to factor in COVID. And this is just going to put more oil into the market. And even though it's not a huge amount like Saudi Arabia, again, it's enough to the point where we're already in an oversupplied market. Every little bit additional hitting the water is going to be a problem when we look at overall pricing, as supply, continues to kind of drift higher and the demand just isn't there to support that additional supply. Now that we've discussed some of the OPEC shifts and some geopolitical components to oil supply, now we really have to look at the demand question, because there's always two parts to pricing, and we really have to consider what's happening on the demand side. And at this point, we're going to talk more about emerging markets, because in our economy show, we're going to talk more about developed markets and compare and contrast. But here we're going to really dig in on China and emerging markets. So let's just kick off with Saudi Arabia's budget, because it's interesting, a nice little segue from OPEC to this. You can just look at Saudi Arabia's budget going back to 2015. And here you can see the deficit continues to grow. And just to give you kind of an indication of how bad it's been, oil revenue was down 45% in the second quarter from the same period last year, which is about 25.5 billion. So now take that, and non-oil revenue drawn from sources like taxes and fees was down 55%. So these are real issues. These are real spending initiatives that they've done to help kind of spur the economy. But at the same time, they've also lost tax revenue and fees, which I think any country in the world can say that. It's just you're going to feel way more pain at the emerging market level because your ability to stimulate on a fiscal and or monetary level is limited due to fears of inflation and other types of restrictions in terms of just size of availability and like what nugget can you actually give to your constituents to help support. I mean, just to give you another quick breakdown, the deficit more than tripled from the first quarter to 109.2 billion reals, even though authorities cut spending 17%. So they've cut spending and their deficit has more than tripled. And this is Saudi Arabia. This is a country that's producing 10 plus million barrels a day of oil into a market that, let's just say the market right now demands 85 to 90 million barrels a day, and they're having trouble. So now we can take it back and we can start looking at, okay, well, if Saudi Arabia is struggling, what's happening in other regions? And now we can just look at real yields of emerging markets versus developed markets. And you can see how the yields have come down. But in terms of the real yield coming down, the spreads have come down because we have, it's a weird time. Like right now you have the dollar that's essentially imploding based on the fact that Powell says he's going to print us into an oblivion. So now you have the DXY or the US dollar losing favor, and you have inflation fears in terms of, well, what's happening in the US? And given inflation is relative, but if you look at inflation in the US in relation to food, in relation to healthcare, in relation to housing, in education, inflation's real. And to think that it doesn't exist in other places where that food scarcity is an issue, where food income is a problem, you're going to see additional strains at the emerging market level, which is why we've seen some of these countries pull back from monetary stimulus because they're facing their own inflation fears. And that's something that we're starting to see where, that headline CPI is really starting to compress. And this is where we're going to start to see some of these issues. And obviously it really happened as things accelerated. And as we go through, the next couple of weeks and the BIS puts out updated information. We're going to show you, what does it look like with emerging market debt? How is it broken down? Is it euros, dollars? What is gold back going to look like? What is gold doing? And that's where you can really start to get a real sense of fear in the market in terms of inflation hedges. And that's why we look at this in terms of negative yielding debt. So obviously emerging markets, they can't afford not to have negative yielding debt. They have to have something that's positive and has to cover inflation, because people are sitting there saying, look, you're a riskier asset, so I demand something higher in terms of an interest rate. But what about negative yields? And here you can see where people are saying, okay, well, negative yielding bonds are increasing, which means people are pulling back from risk. They're saying, look, even though you're paying a higher interest rate, I just want cash preservation. I just want to make sure I get my money back. I don't care if I make money on this bond, it can't even be covered by inflation. This is a real issue. And that's why we're starting to see gold prices also increase, because gold has always kind of been a natural progression in terms of that inflation fear. And that's where we've seen gold, we've seen silver, we've seen some of these precious metals really catch a bid as an inflation protection, as we've seen emerging markets start to struggle, which they're having a good day today as the dollar comes down. But again, negative yielding debt going up. People are starting to get a little concerned about, okay, where is this going, and what is the rationale for investment? And then we turn to China, because China, obviously one of the largest quote unquote emerging markets in the world. And we look at the countries that have signed on to the BRI, or the Belt and Road Initiative. And, Brazil's technically part of it, but you can say it's not under the BRI, it's under something else. But anyway, they should also be factored into this, as, in my opinion, just given the deals that they've signed. But they have deals with over 100 different countries across hundreds of different projects. Now, it equates to about $8 trillion, and just look at where things are all lit up. I mean, most of these countries are not developed countries. They're emerging markets. So not only is the emerging markets, their economy struggling, they also have to pay back debt to China. So now China is going to see an increased amount of pain in terms of bad debt expense. Is that money coming back? Is the project even viable over the next few years? This is the additional pain that no one really talks about within the Chinese sphere of influence. And just look at the countries that aren't involved. You have the US, you have Australia, you have Japan. Clearly people that are on the and obviously key India, that aren't part of this sphere. And it's not for lack of reasons to invest with China. It's more about the debt trap that is really a part of this Belt and Road Initiative. And when we think about the Belt and Road Initiative, you must transact in yuan. So your goal, or yuan, your goal is to you get your money in yuan, then you have to essentially only purchase from China. You have to source Chinese workers. But what does it do? It helps diversify away from US dollar, because you're creating a yuan that economy, essentially. You're only transacting in what you deem necessary. Now, Zero Hedge and some of the others talk about how there's been a slow China has quietly done this. It hasn't been quiet. This has been a known trajectory, especially as the Belt and Road Initiative really kind of hit its stride. And as we saw Made in China 2025, some of these other progressions, the goal is to use the dollar less. And now, as we start to ratchet up sanctions and we start to see the back and forth, now the conversation shifts to, should we stop using US bank SWIFTs, which is just a means of moving cash back and forth. And these are real problems as we consider who's the buyer of dollars. Who is the buyer of last resort for the US dollar? And that's where we start to really see, okay, well, what is going to happen to China? What is going to happen to these emerging markets, especially as the US continues to ease, which we'll talk about in our economy show. And here we talk about China imports from the US. Last week, we showed you the top 10 countries, what they're currently in some sort of political fight with different ones. What does that mean? How does that get addressed? And here is just another way of describing the Chinese imports from the US. we're 23.3% of target, and we're essentially a few days away from being complete in July. So clearly hitting that target is not feasible. And at the same time, no one really thought it was. At least we didn't think it was, even when it was signed in January. So here, the Asian nation promised to purchase an additional 200 billion goods and services in 2020 and 2021, to give you an idea of where this sits, signed January 15th. And we're currently sitting here, and we're 23.8% of targeted agriculture purchases and 5% of targeted energy purchases. Now, they're not buying our oil because it doesn't make economic sense to bring our oil there. They're sitting on a huge slug of crude that's right offshore. They also are cutting runs, and they're dumping refined product into the market. That number is not going to close. If anything, that number is only going to go down, especially as we ratchet up the different issues on a political level. And again, this also comes down into circuitry, into tech. These are the problems that we're going to see in terms of closing this deal. And now, when we consider, okay, well, what about activity? Is there a way that we can see activity increase? And even if they don't want to deal with us, they have to. Well, here's daily consumption using some leading indicators and daily consumption within the Asian nations. You can see that we're still well below 2019, and we don't see that closing anytime soon. And we'll go into a bit more detail in the economy show. But again, this is something that is going to be relevant because this directly impacts industrial production, diesel demand, gasoline demand, and just the inherent pull through of oil. Where is this oil that they have sitting on the coast going to get run when they're sitting on a record amount of refined products? And now, we talk about, the Three Gorges Dam, we talk about India, China, but now we really need to dig in on the Three Gorges Dam because this is meaningful. Now, you're starting to see news about, the dam collapsing. What happens if it collapses? There's a structural integrity issue that has always been a problem and was raised as a concern. And now there's people making news about, it shifted, it's now deformed. Things can get deformed to a point. And any engineer who's watching this, I don't mean to butcher the terminology or to downplay it, but let's just say that there's an allocated amount that a structure can shift without essentially deteriorating the actual integrity of it. And this is important, where the Three Gorges Dam moved, but it moved within a measured amount that is allowed based on the engineering stress tests and what is the tensile strength that's left within that structure. But again, the fact that it's moving after this is now its second big flood, you can say 2017 was another, and there's a huge surge coming that started in Tuesday, and it's only going to increase. And they've already opened up all of the floodgates to essentially just flood the downstream to protect the upstream. And this is why we're looking at this three-dam gorge floodplain. Because even if the dam doesn't collapse, these are the areas that are going to be impacted the most, because this is the lowlands, which make up a huge amount of industrial production, pharmaceutical production, farmland. These are the issues that we're starting to see in terms of the amount of rain that's just been crushing through this area. So, there's already been loss of life, and if the dam were to break, it would impact about 400 million people, 60 nuclear reactors, depending on, the severity of the flood. So this is a real concern. So not only are we seeing a rise in COVID cases in the northern part of China, in specific provinces that continue to have new outbreaks, so there's shutdowns happening there. There's a reduction in industrial production that's being caused by COVID. Now we flip to the other side and we look at, okay, well, what's happening at the Three Gorges Dam, both upstream and downstream, based on the amount of flooding. They've already destroyed 2 dams using dynamite just to relieve some of the stress. And this is why there is a huge focus, because China, you have to look at what China's doing and what are their actions, because you can never really believe what they're saying or what the talking points are. And this is one of the reasons why we really look at the seepage. What is happening? Is it natural? Is it unnatural? Is it allowed, unallowed, not allowed, just based on the engineering profile? So this is something that we're going to continue to watch, because this could be an even bigger impact, because Sinopec has already cut runs in this area by 10%. And we could see runs cut further, which again will slow down oil consumption, just because there's no demand for the refined products given the flooding that is actually taking place. So thanks again for watching. We're going to be coming to you with our economic show, which will have a bit more color on a deeper dive on different aspects of economic growth. What does it look like? Is there an additional slowdown? And then obviously our favorite show, the Primary Vision Frac Spread Count. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Thanks again.